Lewis talking in the dead of morning, telling you to avoid financial schemes all your life. You were only waiting for this moment to arrive. All right. I've actually played that song on guitar before, Blackbird. It's nice. I'm horrible at guitar, but I spent a weekend just learning the chords to that song, which I have now forgotten, thankfully. Good morning. It is the 22nd of January. Woo! And today I am going to talk about complicated financial schemes because recently, I guess probably because I watch financial YouTube videos, I'm getting ads about really dumb banking schemes. And I've also seen people talk about them on certain forums. So I wanted to discuss them with you so that you would know to avoid them. I think I've already failed. My goal today is to avoid saying so, like, or you know. I think that's going to be difficult, but it's worth trying. Complicated financial schemes are usually a ripoff, and I want to give you an example of one so you know what I'm talking about. I'm going to use the example of what is called velocity banking. You can look it up on Google. There are videos on YouTube describing it. I'm going to give a brief description here. Velocity banking is a strategy where you treat a line of credit like a bank account. It's often pushed by financial consultants who want you to pay them money so they can explain and guide you through this complicated process. The way velocity banking works is that you pay your entire paycheck down on a credit card. So, great, I said it. Say you have a credit card with a $10,000 balance and you have a $5,000 paycheck. You pay the entire paycheck down on the credit card. Then you pay all your bills with the credit card. If you spend less than what you make that month, that would mean every extra penny from your paycheck is going to be paying down the credit card debt, which is generally high interest debt. If your credit card's interest rate is, say, 16%, that means in terms of cash flow, you're getting a 16% return on all your savings that month. Sometimes velocity banking is explained with a home equity line of credit. They say you can pay off your mortgage in 5 to 7 years using this method. So home equity line of credit, HELOC. You may have a HELOC with a $15,000 max or cap. You would take out $12,000 from that. You'd pay down the mortgage. Then you'd pay all of your bills out of the HELOC. You would also pay your entire paycheck into the HELOC. Over time, the HELOC would drop in balance if you are making more than you are spending. And when it gets down to zero, you would again take out, $12,000 out of $15,000, pay that big chunk down on the mortgage, and continue this process. The idea here is basically that by putting all of your income into paying down high interest debt or debt interest up front, you are saving a little bit of money because you're not paying as much interest on the debt over time. That's velocity banking. The problem with velocity banking, which is the problem with most of these schemes, is that even if the mathematical models show that you'll get some kind of marginal benefit, and it really is usually marginal. It's not a life-changing it's not a life-changing amount of money that they're saving you. When we look at how people actually behave and how people actually execute these plans, they usually fail, and that failure results in losing money. I want to point out now some risks and also what usually happens when people try different complicated financial schemes. With velocity banking, first one I'm going to cover, we have a problem with risk during financial collapses. And financial collapses happen on a regular basis. For example, in 2008, when the credit system freezed up, many people were sent letters that said, "We're closing your HELOC. We're freezing your HELOC." If you use a scheme like velocity banking, where you've just paid your entire paycheck down on this line of credit, and that line of credit is no longer available to you, you can't pay your bills. You can't buy groceries. You can't do anything until the next time that you're paid. If the economy has just suffered, you may have just lost your job at the same time that your line of credit freezes up. On top of that, if you decided to use the HELOC line of credit method because you didn't have a credit card, that HELOC has a $600 payment on it that you have to keep making right at the moment where your cash flow is questionable and you want to save money because you're worried about the economy. That's dangerous. Second point for velocity banking is that there is no mechanism here to prevent someone from running up the balance on the credit card again or running up the balance on the HELOC. Statistically speaking, we know people love running up balances. So I think it's a bad idea. There are people pushing this stuff on YouTube, like this guy right here, showing these numbers go down, working out the math, but he's not addressing the behavioral problems people have, which dominate their financial results. That's velocity banking. I suggest that you avoid it. And I need to make my window a little smaller so that I can make sure I see what you are seeing. The second thing I want to discuss is hedging a loan against investments. Generally, this is going to be pushed or discussed by financial advisors or by loan officers when you take out a mortgage, or by someone selling you a car. They're going to say if you take out a 30-year mortgage instead of a 15-year mortgage, you're going to have more flexibility. On the one hand, they say you can pay the difference between a 30-year mortgage and a 15-year mortgage, and you'll be done in 15 years. Or you can invest the difference in the payment between a 30-year mortgage and a 15-year mortgage. And because the rate of return on investments is generally higher than the interest rate on the mortgage, you'll come out financially ahead at the end of 30 years. There are several problems with this. One, overwhelmingly, people do not prepay 30-year mortgages. It's something like 98% of people do not systematically prepay 30-year mortgages. So when someone tells you you can pay a 30-year like a 15-year and it'll come out the same, that's technically true. It's extremely likely that you're not going to do it. So it's a fantasy. So. The second point is that the risk-adjusted returns of money from investments are lower than the kind of stated returns, which means that the difference in your mortgage interest rate and what the market supposedly returns is smaller than what you'll get if you just take a historical average. Risk adjustment of returns is a complicated topic that I don't want to discuss right now. But the point is, the benefit is not as great as a lot of these naive models would suggest. The last point I want to make is that I have to read this. It's definitely the morning. A lot of people will say, and I thought about this when I paid off my mortgage. They'll say, I don't want to prepay my mortgage or pay off my mortgage because I'm scared of not having money invested in the market for too long. And that's it's a similar discussion when you're talking about, taking out a 30-year mortgage versus a 15-year mortgage and investing the difference. People are afraid of not having an investment going on for too long of a period of time. And what I would say to that is, if your mortgage is so high compared with your income that you can't pay it off quickly, let's say 5 years, then you probably bought too much house when you look at the overall financial plan. I'll just have to refer you and link you back to my my housing video. I'm slowing down. That's my opinion about hedging debt against housing costs. And the last point, people will say take out a car loan instead of paying cash for the car so you can keep that cash invested. Same reason as the housing. If it's so much money, you probably bought too much car, and the actual amount of money that you will save given the 3-year horizon on your car loan, the market returns are so volatile, it's really not guaranteed, and I wouldn't mess with it. The next scheme I want to discuss is paying off highest interest rate loans first. This is the other popular way people say to pay back debt rather than the debt snowball. It's true that compared to the debt snowball, when you work out the math of paying off high interest loans first, you save some money. Problem is, fewer people actually end up paying off their debt when they use the highest interest rate loan method. The snowball method works more of the time because as people see those smaller loans get paid off, they get more inspired and encouraged. And people are not robots. They need inspiration and encouragement. Don't pretend that's not true about yourself. Use the debt snowball method and pay attention to psychology when you are planning your financial life. The next one is debt consolidation loans. Number one, most debt consolidation loans don't even save you money. The interest rate that it's like bingo. I'm hitting all of them. They will combine all of your separate payments into one payment, but the interest rate on that one payment isn't low enough to justify doing it mathematically. A lot of them will also charge some upfront fees for doing the consolidation. That's number one. And beyond that, even if you are saving some small amount in interest, the size of your payments dominates your overall savings outcome when it comes to paying down debt. We want to be 95% focused on making large payments on the debt and maybe 5% focused on a consolidation. The consolidation is only going to matter if your debt is $100,000, $200,000. If it takes 2 years to pay off. If you can pay off the debt in a year, you're not going to save that much interest anyway through a consolidation, even if the rate is better. I think the bigger problem, though, with debt consolidations is that they make people feel like they did something about the debt, but they didn't do anything about the debt. It saps your motivation to make those larger payments to actually fix the problem. Just like in the last video, I didn't want you to become complacent about your finances because you see a high credit score. I also don't want someone to become complacent about their finances because they have a lower monthly payment because they consolidated debt on a longer time period and now they have more cash flow. We're not after cash flow. We're after net worth. And when you have debt, the number one goal to raise net worth is to pay off the debt as quickly as possible. We want to stay focused on that. Debt consolidation can be a distraction. It's not the worst thing in the world, but it also doesn't move the needle forward in a significant way. The last one I want to discuss, people will refer to as a LRP. My financial advisor tried to sell me on this. It is one of the worst in this list, both because it's really complicated and because so many people are trying to sell them and make commissions from selling them. LRP stands for Life Insurance Retirement Plan. It's a complicated scheme involving life insurance where you pay a premium for some kind of life insurance. Part of that premium is going to be put into investments, and that investment balance will build up over time. They'll then say once it reaches a certain point, you can take out loans from that built up investment balance that are tax-free. So you're not paying money, you're not paying taxes, and that's if you have a high income and you're at a high tax rate, that's the selling point of these schemes. And yeah, that's, I guess, LRPs in a nutshell. They also have features such as they will guarantee you either a positive return in line with what the S&P 500 is doing, or if the S&P 500 is negative, they say they'll just pretend that your investment accounts did zero that year. The problem with LRPs is that hidden inside these complicated contracts are high investment fees, high fees period for managing the account over time. Many times what it is invested in is not even something like the S&P 500. It's something with a much worse return. And finally, if you want to remove or get out the cash balance that you've built up, many times there are horrible penalty fees and you can't do it. Once you get into the LRP, it's really hard to get out. Once you get in and you realize this is a bad deal, they're going to penalize you with a huge loss for withdrawing all your money so that you can put it into a simpler investment with a higher rate of return. There are also contractual gotchas, like if you miss a premium payment, suddenly there's a terrible penalty for it. I forgot specifically what it was. It may be something like what the insurance payout is when you die. But I remember thinking, Holy moly, you miss one payment and that's what they do? So. Avoid life insurance retirement plans. Avoid any kind of retirement plan that has the word insurance anywhere near it. They're a bad deal, and I don't know anybody who, once they understand it, is excited to still be in it. That's it for today's video. Avoid complicated financial schemes, systems. I didn't decide on the best word for this. There were a number of good ones. Contrivance, that was a nice one. Generally speaking, the more complicated the money flows, the worse of a deal it is for you. The best deals that we can have in money are the income that we generate for ourselves and understand ourselves, and investing money in productive enterprises that do real valuable things for real people over a long period of time. That's it for today's video. Have a fabulous Monday. Get jazzed about your week. I know I am. All right, enjoy your day.